Well, just this month, the Federal Reserve came out and said that inflation was cooler than expected. The bond market reacted. The stock market reacted. What's more important is how does it affect your hard-earned dollars? Stay tuned to the Retirement Income Source, where it's all about the income. And welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. And today, of course, we're going to be talking about this inflation report and what you need to know and how you need to react to it. But first, Sarah, how was your week?
It's been a pretty good week, Dave. You know, it's always busy around here. How was your week?
Well, inflation was rampant in my household because last week we had 6 18-year-olds, recent high school graduates that descended on our house. So I can assure you my personal inflation rate skyrocketed last week, regardless of what the Federal Reserve said.
I can only imagine what your grocery bill looked like.
That's very true.
And I'm sure it was higher than this time a year ago when they came to visit, right?
Absolutely.
Yeah, absolutely. Well, that's why this show is so important for all of our listeners today, and we appreciate you joining us here on the Retirement Income Source.
Yeah, and today we're going to approach that topic of what the Federal Reserve announced, what happened with inflation in the month of May, the economic growth rate in the month of January, and also how the bond and stock markets reacted, which they did both over the last week. But let's start with the Fed report, I guess.
Yeah, let's talk about inflation and what the Fed report really means and what their perspective of inflation is now.
Well, first of all, it was just 1 month, right? May's report was favorable. But I wouldn't read too much into that because remember last year we had the first half of the year the inflation was lower, and then in the third quarter it started to ramp up into the fourth quarter, and now it's cooling down again. So we kind of got a head fake before. Just 12 months ago we might get a head fake again. But for May, Sarah, we ended up with essentially a headline inflation rate that month over month was 0. And a core inflation rate, which the Fed prefers, which is when you eliminate fuel prices and food, of 0.2%. So if you use the core, 0.2% in a month, that's essentially 2.4% a year, which starts to get dangerously close to the Fed's goal of 2%. And when I say dangerously, I mean in a good way.
Yeah. So do you think that the Fed, a lot of people think that the Fed maybe waited too long to even raise the interest rates. Now they're maybe signaling that they'll lower the interest rates quicker. What do you think, Dave?
Well, that's a big concern. There's some talk about, are they going to lower rates once this year or maybe twice? Now, remember, going back to the end of last year, they were saying, gosh, we might have a half dozen or 8 rate decreases this year. And now we're arguing whether there's going to be 1 or 2. But you're right, because the Fed took so long, they were kind of caught flat-footed to raise rates, even when they knew inflation was here. And now they're so worried about inflation coming back that a lot of people worry that they're taking too long to lower rates, which goes back to part of the rationale why we say that the Fed has almost never created a soft landing. The Fed has almost always created a recession by keeping rates too high for too long.
Yeah. Well, Dave, you mentioned your grocery bill was a little bit higher, having a bunch of teenagers in your house. And our next Ask Dave question has to do with inflation and the cost of things. So we have a question here from Jan in Tennessee. She says, if inflation is calming down, when can I actually expect prices to calm down?
Jan, great question. And unfortunately, unless the Fed causes a severe recession, you're probably not going to see prices come down. So it's important to understand, when we say inflation goes down, we mean the annual rate of increase of prices goes down. But usually prices don't come down unless we're in a severe recession, actually called a deflationary environment. And that really truly is a severe recession when prices come down. So best we can hope for is probably that prices stay flat for a while or the increase starts to slow down. But the reality is that most of the time, inflation does not go backward. So think of it as a bunch of step stairs, right? It goes up, it stays level for a while, it goes up, stays level for a while longer. And what we're hoping is that we're at that level period. So I don't think we're going to be able to take back those prices and hope for lower prices coming up. But what we can hope for is to stop the pain moving forward. And the good news, Jan, is I don't know about you, but in most cases, the inflation that people have felt over the last 3 or 4 years has just about exactly matched the average increase in wages. So unfortunately, that means that most people have gotten raises they haven't had any real raise. They can't spend any extra, but the raises they've gotten in most places have at least equaled the rate of inflation. So now if that levels off and you're still working and you continue to get pay raises, maybe that's extra money that can actually go in your pocket for discretionary things as opposed just to cover price increases.
Jan, thank you so much for sending in your Ask Dave question. And if any of our listeners have a question maybe about inflation or how this could potentially affect your retirement, all you have to do is send us an email to askdave@retirementincomesource.com. Thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're doing a little bit of a market update show. We're talking about the recent inflation numbers, talking about what the Federal Reserve is signaling, and it looks like with inflation calming down, it caused both the stock market and the bond markets to really react. But the most important thing is how this is going to affect your portfolio. And Dave, you just answered a question from Jan. Honestly, it was a little bit disheartening to say, because you said that these higher prices are pretty much here to stay because inflation really doesn't go in the reverse.
Right. So we say inflation is coming down. We don't mean the prices are coming down.
Yep.
We just mean the future increases are now going to be at a much slower rate. And if prices do start coming down because we're in a deflationary cycle, that means we really have some economic problems. We're going to see unemployment, coming up to a pretty high level, and people are going to be struggling. So we actually don't want prices to come down. Yeah. That's a bad thing.
That's actually a bad sign.
But we want them to stop going up, or at least start going up at a lower rate.
Yep. And we talked too about how maybe some people thought the Fed had waited too long, and you mentioned the Fed really they can't really create a soft landing. It's kind of a difficult boat that they're maneuvering, right? Like it goes too much in either direction and it causes a ripple effect. Yeah.
And it's, I always make the airplane analogy, right, as a pilot. And I just, this past weekend, I had my annual simulator training that's required by the FAA. And it's great because we have the most modern instruments and we can tell immediately what's happening. So as I always say, if I have air traffic control telling me to slow down, I can pull back on the throttle, and then when I get to my target speed, just go ahead and put enough power back in to hold. But I can control it that precisely. And the problem is that with the Federal Reserve, they don't have tools that are that modern. So they pull the throttle back and they're guessing the rate at which it's slowing down. And sometimes they keep it slow for too long and they essentially stall the airplane, which is the same thing that would happen to me if I forgot to put the power back in when I got to my desired speed. Eventually the airplane would fall out of the sky. Yeah. And that's the problem with the economy too. The Fed can't really determine that because, again, even our economic growth rate, known as GDP, right? First half of last year started to slow down. Second half of last year got to an annualized rate of 3 or over 3. And now the first quarter is showing an annualized rate of 1.3%. So that shows that the economy is slowing down, which makes sense why those CPI numbers, the headline and the core, are also slowing down. And I think the good news is a lot of that is, this last month, a lot of the decrease has come from the service sector. Remember, the service sector, ever since the pandemic, was the hottest sector, right? Because once we open up, everyone's traveling, everyone's going out to restaurants, staying in hotels, and that was really pushing inflation up, and that seems to be calming down. So that's good news.
Yeah. Well, it's understandable in a sense. The economy is a lot different from a small airplane. It doesn't have the same ability to maneuver as quickly, like you said, in the Federal Reserve. But we're also lucky, I guess, the Federal Reserve is not controlling the ATC, right? The air traffic control system.
That's right. They're not controlling the FAA. They have a tough time controlling what they do themselves. But most importantly, coming up, we want to share with you how the stock market reacted, how the bond market reacted to this news, and why that should be a signal as to how to manage your hard-earned retirement dollars. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about the recent inflation report, the different reactions we saw in the stock market and the bond market, but really ultimately what it means for your retirement and how you can make sure that your portfolio is more protected. So Dave, just a few minutes ago, you mentioned, I mentioned that we did see a big reaction in the bond market and the stock market when the CPI came out, when the news came out. So can you explain a little bit more about how and really why both those markets were affected by the news?
Sure. Well, first of all, the bond market. The bond market's always trying to speculate where, when the Fed is going to lower interest rates, right? So all of a sudden now, the economists who thought there was virtually a zero chance of raising rates in September and maybe a chance of raising toward the end of the year, now a lot of them come over and said, hey, we might raise rates in September. We might lower rates in September again. I meant to say lower, not raise on all those situations. And so you might lower rates. And as a result, the yield on the government bond, 10-year government bond, went from 4.6 down to around 4.3. And that's a pretty big drop to have happen in a matter of just a couple of days. And what that tells us is two things. Number one, that if this is true and inflation is not that much of a concern anymore, that there definitely will not be another interest rate hike. I know we didn't think there'd be a hike, but there was always that chance. So that chance now gets closer to zero, and the chance of lowering rates sooner is greater. So the bond market reacted to that. Okay? So that's important. The next thing is the stock market. Now the stock market as a whole didn't react as much to that, but it just extenuated a cycle that had already been happening. In an early cycle recovery, Sarah, when you come out of recession, the large company stocks, called large cap stocks, do well first. The blue chips do well. And we saw that, for example, in 2022, after what we saw with the pandemic. So 2021, for example, with our large cap strategies, we were able to outperform the S&P 500 index. 2022, the S&P was down double digits. We were positive with our large cap strategies. So those all worked. But then, starting last year, all of a sudden, the transition started to go to more medium-sized companies, smaller companies, more tech companies. And that's what's called a latter stage part of the recovery cycle, when all of a sudden you go from the blue chips to the riskier plays. Because, the optimism starts to permeate throughout the market. The animal spirits, as they call it, with all the traders, start to extend to the riskier positions. And that's why over the last year and a half, or at least over the last year and a quarter, the tech stocks, the smaller companies, have outperformed the big blue chips. And you can see that because the Dow Jones Industrial Average, which is the blue chips, right, is off its record high by, call it 3%. But the S&P 500 and the NASDAQ keep making new record highs every day. And the NASDAQ, as we know, is more the tech stocks and more aggressive. In fact, we saw that in the late 90s. We had a late cycle recovery, and it was that big tech bubble, right? But now the S&P 500 has even gotten to the point where it's so weighted toward the technology stocks that along with the NASDAQ, keeps setting records every single day. So this is where you got to start to be cautious in the market and not just be arrogant, because the next step after a late cycle recovery is typically a recession and a contraction of the economy.
Yep. And we talk about market cycles all the time, Dave. So it's a little bit of a warning maybe that we're in that later market cycle. Let's get into our Ask Dave question, because I think a lot of people might be in the same boat that James from Georgia is in, where maybe they waited a bit too long or they're still overly invested in the stock market. So James from Georgia, he writes in, he says, you might be disappointed to hear this, but I've really been postponing transitioning to income, even though I should, because I've been making way too much money in the stock market. So is this really a bad strategy if I'm making a lot of money?
Oh, James. Well, first of all, thanks for understanding that I might be disappointed. But no, I'm not disappointed, primarily because I don't think you haven't been hurt yet by this. And it might be through, don't take this the wrong way, James, but part of it's luck, the timing, right? And that's because interest rates have stayed high. They really haven't started coming down yet. And because those stocks have continued to climb and set new records. But the point is, we never know when that ends, that trend ends, that cycle ends. I mean, I remember back in the late 1990s, for example, we had a pullback. I want to say it was August of 98 and again October of 98. And I thought that I had missed an opportunity to take a lot of my clients out of the market. And I was kicking myself. But yet we then had another 15 months or so of exponential growth where those technology stocks took off. So the problem is you can never figure out where the peak is and where the trough is. But just understand that you're getting to the point now where you're taking more and more risk by having FOMO, by having fear of missing out, right? So as you get to early stage cycle, it's a little bit easier. Mid stage cycle, this is the late stage cycle. And now what you're trying to parse out is this is the beginning of the late stage cycle, or maybe close to the end of the late stage cycle. And I can't answer that question. Nobody can. And frankly, that's where the gamble comes in. All I can tell you, though, is that usually the next step is economic contraction, where the market starts to pull back overall. And, the more tech stocks or the small cap stocks tend to pull back more than the large cap or the dividend payers. Now, I could also tell you is that when the Fed starts lowering interest rates also, now when you make that transition to an income first, growth second focus, that now you're going to be locking in at a lower rate of income. So you take the risk of getting hit on both sides, having less money in a lump sum to transition to income, and then getting a lower interest rate once you make that transition. So I hope that helps.
Yep. James, thank you so much for writing in and sending us your Ask Dave question. And if any of our listeners or even YouTube viewers have a question that you would like to ask Dave, all you need to do is send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about the recent numbers and how it reflects on inflation, plus what we saw happen in the bond market and, of course, in the stock market. And Dave, you just answered a really great Ask Dave question from our friend, our listener, James in Georgia, who said he's just making too much right now in the stock market. He doesn't want to transition to income. And you really issued him a warning where you said, hey, you might have gotten lucky so far, but things are looking like, if history tells us, things could be going downhill shortly. And here's the signs to be on the lookout for. And we don't want that to happen to our listeners. We don't want you to get caught in a down market.
Yeah, if I had been a little sharper with James, I might have pulled a Clint Eastwood and said, the question is, are you feeling lucky? Because that's really what it comes down to. And I assume James is, either retired or close to retirement within 10 years. And that's where that lucky factor comes in. Because again, I thought we were about to hit a drop in 1998, and we went on for another 15 months. But if you didn't heed that warning, then you're underwater for 13 years. And of course, the fact that we were underwater for 13 years once in the market, the century, tells us it can what?
It can happen again. It probably will happen again.
That's at some point.
At some point.
But even if you get a pullback and it's 5 or 6 years, and here poor James wants to retire in 2 or 3, he might be behind the power curve.
Yep. And that's why it's so dangerous to still be in that situation, because like Dave said, you might have gotten lucky so far, but you could end up in a situation where you lose everything. And if you're 13 years into retirement, if you retire at 65, Dave, that has you going back to work in your late 70s. Who wants to do that? Nobody wants to have to be in that position or running out of money.
That's right. And I'd like to think that, if James has enough money, that he could take some of the money and move it over to an income first, growth second approach, where he can have, get the income that he's going to need in retirement, solve for today, and still leave some money in the growthier stuff, the tech stocks, the Magnificent Seven.
Yeah.
So he still feel like he's in the game, and if he has a bit of FOMO, hey, I can still make some money. But if you're overloaded too much in that, then you're really playing with fire, and that's absolutely true. And I know so many people who in the early 2000s did that, where they had a lot of money in one stock or a handful of technology stocks, and when the market dropped, they're either forced to retire later or work part-time throughout retirement or spend a lot less, and it's not pretty.
Yeah.
And again, I really hope that this is the one time the Fed can execute a nice smooth landing. I soft landing.
The one time in history that it might happen.
I hope they can, and there's some signs that it's possible.
Hey.
But the signs just this past couple weeks have increased to say that maybe it's not possible. Maybe the opposite is true, and maybe they'll engineer another recession.
Yeah. Well, there are problems with staying invested in the stock market too long because you've been lucky. But there's also problems because your opportunity for investing at the higher interest rates is slowly closing, just like Dave mentioned. So if you want to take advantage of that and more opportunities, we're going to give you some tips on what you should do now before it might be too late. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about the recent inflation numbers and how the cooling of the report showed that some of the numbers have really come down, including what we're seeing in the stock market and the bond market. We saw a huge reaction from both of those markets. And Dave, I mentioned before, that it might be time, and you mentioned it might be time for people to get out of the stock market. But there is a right and a wrong way to invest for income in the stock market, correct?
Right. So you don't have to necessarily get out of the stock market.
Yeah.
But these growthy positions that have been doing so well over the last couple of months, a lot of the technology, they typically pay a very low dividend yield. So they don't pay a lot of income. But if you want to stay in the stock market and you go to more of a higher dividend value approach, you can still get 4.5% dividend yield in the market
Yeah.
and still be in the game. Now, maybe it's not the hottest part of the market. It's not going up as fast as the Magnificent Seven, for example.
Yeah.
But also, if things turn on a dime, you've got your dividend coming in. And remember, dividends don't change
Right.
when the price drops.
Typically, we hope they don't. They usually don't. Right.
Right. They have to make a decision to
Yeah.
change dividends. Just as the price drop doesn't mean dividends are going to change. But it also means that usually when the markets turn, it's those growthy names that drop a lot faster and a lot further.
Yeah.
And the higher dividend conservative stuff tends to stay a little bit steadier.
Yep. So it looks like the window of opportunity might actually be closing on people that want to invest at those higher interest rates in the bond market.
Yeah, and it's hard to tell because,
Yeah.
you know, when we had the first drop in 2000 with the tech bubble, I want to say federal funds rates they were in the sixes, and they dropped to 2%, you know, by, I
Pretty
believe it
big
was
drop.
the end of 2002. And that was pretty quick,
Yeah.
you know. Then they got back up to about 5, and then when the financial crisis hit, they dropped to 0. So again, very quickly. So when something bad happens, it's kind of precipitous,
Yeah.
and you know it's hard to react to it. Everybody thinks they're going to react to it quickly, but you're kind of blinded. You don't know what's happening, so you get caught on your heels, and you lose potential income for a long time.
Yeah. What kind of events would cause the Federal Reserve to drop the interest rates quickly? Have we seen that before?
Well, yeah, we saw the tech bubble burst, which was a huge one, and,
Yeah.
and could that happen again? Absolutely, with all the AI stocks. We also saw the financial crisis. That's another example. So what do we have right now? Well, in the financial realm, you still have the regional banks that the problem hasn't been fixed. And part of the problem is the Fed had raised short-term interest rates, and that's why the regional banks are struggling so much. So far it's been a little quiet on that, but we could have another round of regional bank failures, and that would cause the Fed to maybe have to drop rates significantly. Or geopolitical. We get pulled into a war of some sort. That's always a wild card, and you know, you don't need me to tell you there's a lot of crazy stuff going on right now around the world.
Right, yeah. Choose your own adventure. All right, let's get into our first Ask Dave question of the segment. We have Tim. He comes from Tennessee. He says, Dave, I'm an avid listener of your show, and I transitioned to the income first method a couple months ago, but I do have to admit I'm a little disappointed because I feel like I'm missing out on the gains.
All right, Tim. Well, you should have been in my house last week with those half dozen 18-year-olds, recent high school graduates, because I think you have a little bit of FOMO, my friend. I hate to tell you, you know, and the kids always have FOMO, right? It's kind of like, well, I'm tired because I was in the beach all day and swimming in the pool and doing this and that, but I have to go out. Why do I have to go out? Because I might miss something. There might be
Right,
something
I don't want to miss
fun
out on a fun
happening.
time.
That's right. And FOMO happens in the financial markets more than anything, and that's why we had that Robinhood debacle coming up just a few years ago with all those meme stocks that everything took off, and you know the prices started to come up like crazy. GameStop and all those. Tim, I hopefully remember that. But you know now it might be a different flavor of FOMO a little bit with some of these IA stocks and or AI stocks. So what I would say to you is this. Look, you know, you're at an age where you probably don't have FOMO anymore on a Friday night. You're probably as happy as I am, sitting on the sofa, chilling out, whether it's with a nice glass of scotch, a glass of wine, or even, you know, some tea, right? You're happy doing that. I encourage you to try to adopt that in your financial life too. And if you made that transition, because you always hear me talking about it, you probably made it because, you know, you realize, look, you have enough money to retire in the lifestyle you want if you transition to income. You don't need to have a lot more gains. So what you really have to think about is, okay, risk versus reward. If I took the risk and I did this, maybe I get more reward. But, you know, if I increase my money by another 20%, am I really going to change my lifestyle in retirement? Right? Probably not. But what if it lost 50%? Well, how would that affect me? And I'm sure on the scale of magnitude, the negative side would affect you a lot worse than the positive side would help you. So, Tim, you know, hopefully you can find a way to get over this fear of FOMO.
Yep. And Tim, thank you so much for sending in your Ask Dave question. If any of our listeners have a question, or maybe you want tips on how to get over your FOMO, if you feel like you're fear of missing out, all you have to do is send us an email to askdave@retirementincomesource.com. And thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been talking about the reaction we saw from both the bond market and the stock market when it came to the recent numbers from the CPI. Inflation appears to be cooling. The Federal Reserve signaled that they might only drop rates maybe twice, maybe once. We're not really sure of what's going to happen. And Dave, we talked about that. It looks like, this could be signaling potentially a recession type scenario.
Sure. I mean, when you do see the GDP trending down, like I said, first quarter was an annualized rate of 1.3. Not terrible. And doesn't mean anything because we were down at a reasonably low GDP rate first half of last year, and then it spiked in the second half, right? But I think there's other indicators that start to show this. Like I said, basic consumer spending in some ways is starting to cool down just a little bit. And food and entertainment with people, the less pressure on prices when it comes to people eating out or flying or staying in hotels. So I think we're starting to see this. And, like I said, we always hope that the Fed can execute a soft landing and not create a recession. But we have years of track record that says that they typically do because, again, they don't have accurate instruments to fly their airplane by.
Yeah. So what would be your best advice for our listeners that are at or near retirement and they want to make that transition to income? They're trying to get over their FOMO, right? But they want to make that transition and they still want to be able to buy in while there's opportunity with the bonds.
Well, the biggest thing is just to say, okay, how much money do I need in retirement to live the same lifestyle I have today? And then how much money do I want in retirement to do extra things? And compare that to where you are right now, how much income your money could generate. Because remember, if you can get 5% of income on $1 million, that's pretty good, right? That's $50,000 a year. But if all of a sudden it drops to $800,000 and rates drop to 4% because we're in a recession, now 4% of $800,000 is only $32. So it's not just that the account balance went down; it's also that the interest rate went down. So see where you are in terms of your I need income goals, your I want income goals, and compare that to how much income you could generate today. And if you're there, hopefully you have enough to at least satisfy your I need goals by going to an income first, growth second approach with some part of your money. Then if you want to gamble with the money that's there for the difference between the I need and the I want, then maybe you can do that. You can make that gamble because you may want to travel to Europe twice a year. You may want a beach home. You may want to do things like that, but you don't need that. But certainly don't push your luck when it comes to the I need goals.
Yeah. Now, Dave, what if you feel like you haven't saved enough to achieve those goals? Is it better to push your luck and try to grow as much as you can, or should you still make that transition?
Well, you still need to be diversified. So if you haven't saved enough to meet those I need goals, you're probably going to be more heavily in the stock market.
Yeah.
But still, if you gamble all with those magnificent seven, let's say the tech stocks, the artificial intelligence stocks, and things go awry. I mean, remember, the NASDAQ dropped nearly 80% back after the year 2000. Well, you think you're behind the eight ball now, you're going to be even further behind the eight ball. So stay diversified. Include those high flyers as part of it, but don't lean exclusively on those. And watch the markets. Watch what they're doing. Maybe trade stop losses. And you have to know what you're doing. If you don't know what you're doing, then you have to go to an advisor that knows how to trade stop losses, where all of a sudden, if something runs up, starts to tick backward, and you can sell it when it ticks backwards. So at least you truncate your losses. You don't ride it down 80%.
Yep. And if you've already transitioned to income, then there is good news, right, Dave? Because you've already made that important shift. You don't have to worry as much when we see the Federal Reserve signaling different things, when we see these different inflation reports. You don't have to worry as much. So we're going to talk about some more ways that you can make sure that you're protected and why you don't have to be as concerned when the market swings in either direction. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we're talking about that most recent Fed report, which said that inflation seems to be cooling, as well as the first quarter GDP report, which also says the economic growth is slowing. So far, we've explored how that affects the bond market when interest rates dropping a full 0.3% in the matter of just a couple days, and how it continues the rally in the riskiest part of the stock market, particularly those technology stocks that are more growth oriented.
But Dave, really, it's hard to know when is it real, because last year we saw they kind of faked us out last year, the Federal Reserve, and then we saw this year we're seeing the same thing with the interest rates. So how do we know when it's time to be concerned, when people should actually be worried, when it's real?
Well, it seems more real this time, Sarah. There have been some reports about consumer debt starting to increase. We didn't have that problem before because all the free money sloshed around, after the pandemic, but now consumer debt, credit card debt is starting to go up, so that's becoming an issue. And it's normal to have things in one cycle and then bounce back the other way. But the question is, how many times does that happen? So I'd say if we get out toward the September Fed meeting,
yeah,
and we find that by then we'll know the results of the second quarter GDP, and are we still in the 1+% or even lower range, right? Or are we going to bounce back over 2 annualized? Also, we'll then know the Fed's decision in September. Are they going to raise lower rates or not? Or are they going to keep things the same?
Yeah.
And I think that'll give us a better feel. That'll give certainly more confidence. And then you get out toward November, you have another Fed meeting, and then you also have third quarter GDP economic reports, and that's when we'll know for sure. So it's coming up soon.
Yeah. So, but it's hard to tell. But hopefully, we'll know more towards September.
That's right, and it's
later in the year.
It's always anybody's guess. You see, economists are the smartest people, right? And they're always split. They're always split when it comes to how many times the Fed's going to lower rates, when's the next reduction in rates going to happen.
Yeah.
They just don't know. And sometimes the bond market is the best indicator.
Yeah.
They always say the bond market's smarter than the stock market.
And why is that, Dave? Why do they say that?
Well, because the stock market has these animal spirits, right, where people get greed and it kind of overwhelms them, and they get in, they pile on, even if they know something's overvalued. If it's going up, they're still going to pile in there and drive it up further because they're making money, right?
Yeah.
But the bond market tends to be more mathematical, more technical, more calculated. And when the bond market reacts, that usually tends to mean something. And recently we saw a little jump, and then with this last report, it came back down again. So I think if rates stay below 4.5%, that's telling us that the worst is probably over when it comes to inflation.
Yep, absolutely. Well, let's get into our next Ask Dave question. We have a question from Allison in South Carolina. She says, should I ladder bonds?
All right, Allison. Well, Allison, you're obviously smarter than the average bear. You understand bond laddering. But for those of you who have advisors, you trust your advisor, so you don't want to get into the nitty-gritty, or maybe use mutual funds. Bond laddering is simply where you buy bonds of varying maturities. You might buy a 5-year bond, a 6-year bond, a 7, 8, 9, 10, 11, 12. And the idea is that if interest rates go down, you have some longer-term bonds that'll go up in value a lot quicker. And when the shorter-term rates start to mature, you're only reinvesting a little bit of your money at a lower interest rate. Conversely, when rates go up, you have your long-term bonds drop in value faster, but you have your short-term bonds come and due, so you can reinvest that money at today's higher interest rate. So the idea is it's a way to kind of hedge your bets with interest rates in the bond market. So my answer would be, as of today, I don't know that laddering is important as it was when rates are going up, because right now I can't imagine rates going up much more, if any more. Again, I think we might have peaked. So when rates have peaked, you want to go out as long as you can, and you want to lock in the long-term rates, because then when rates come down, not only did you get a better rate because you locked in long-term, but also the value of your bonds has gone up. Now, here the good news is you don't need to rush to transition that, because a lot of things, when rates start to drop, you'll see the short-term end drop first and the long-term end drop later. So that means that most likely, you'll get a nice little bump on the short-term, and maybe you won't see it on the long-term right away. So it gives you a chance to sell some of these short-term bonds, even at a gain. Don't wait for them to mature and roll them out a little bit longer. But, once rates drop more than a little bit, you probably want to be more long-term to take advantage of that.
Yep. Well, Allison, thank you so much for sending in your question. And if any of our listeners or even YouTube viewers out there have a question that you want to send to Dave, all you have to do is email us at askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton. And today we've been talking about the recent CPI reports, the inflation numbers, and really what it means for your retirement, especially for those that haven't made that income first transition yet. Dave, I hope our listeners that are in that, that red zone of retirement that are a few years away, I hope they've made the transition. But if they haven't, then they could potentially be at risk, especially at this point in the game, of losing money if they stay invested in common stocks and things like that, pretty much growth investments in the stock market.
Well, like I said, losing even more income than you do money, right? Because if you get 5% on $1 million, you've got 50,000 of income. Well, if you drop to 800,000, you might think, well, 5% of 800,000 is 40 grand. But it's not the whole story, because interest rates are dropping because we're in a recession. You might only get 4%. So now you're a lower percentage of a lower dollar amount. It's not 40, it's probably 30, right?
Right.
And that's the key.
Yeah.
So to me, it all goes back to, your I need and your I want goals. And I mentioned this before, Sarah, but I think it makes sense to talk about it a little bit, because people kind of know what it means intuitively, but how do you back into it? Well, first of all, you have to look at how much money are you truly spending now on a pre-tax basis. So take your income from work and subtract from it any expenses that'll go away in retirement, right? So your 401k contributions, you're not going to be making those in retirement. Any FICA tax that you pay is only because you're working. You don't pay FICA in retirement, so you have to subtract that. Then if you have any commuting expenses, you might want to subtract that are significant. Or if you're going to have any debt paid off by retirement, you could subtract those payments. And then you get down to a net pre-tax number, a number that, okay, this is how much income you're truly spending today if you subtract all the expenses that'll go away in retirement. That's your I need goal. It's what and it's not what you need minimum, because what you need minimum is you can totally pull back your lifestyle, sit at home and do nothing and probably live on less. But it's what you need to live the same lifestyle that you have today. But then you're retired, you have more time on your hands. More time on your hands means that you're going to want to do more things. Doing more things means somehow, some way, you're going to spend more money. So now you have to think about what retirement means to you, what you want to do, and start adding some expenses back. And that's how you get to your I want goals. And Sarah, again, the reason that's so important is because the transition, to me, should be made earlier to an income first, growth second approach with your I need goals. So worst comes to worst, you're going to be okay.
Right.
Your lifestyle's not going to go backward, right? But if you want to gamble on the difference between the I need and the I want, I guess that's okay. But for a lot of people, their I want goals are important to them. They say, well, I'm retiring because I want to do these things, which means maybe they need to transition a little bit more to that income first, growth second approach. But remember, I tell you, it's income first, growth second. So you're not giving up growth. It's just that you're looking at the income side first. Versus, if you're heavily weighted toward those magnificent 7, the stocks that are climbing, well, then guess what? You're more of a growth first and income never approach.
Yep. And I think that's so important to highlight, Dave, because a lot of people think with income investing, they just think, oh, I'm just worried about the income. And yes, income first, that's the first priority. But growth is a second priority. And there's a lot of benefits, especially if you're able to reinvest those dividends. If you're able to do it early enough, you make the dividends. You don't need it because you're still working. You can reinvest it and actually grow your nest egg overall and have more income when you want to retire.
Absolutely. Or like you said, we could be in higher dividend stock strategies, not necessarily that part of the curve, which, the high-tech stocks that are the riskiest end, that are at that latter cycle of the economic recovery. So you can have some growth potential and still have a reasonable amount of income. That's very important too.
Yeah, but it really seems like common sense, right, Dave? You want to get your needs met, and then you want to get your wants met. But if you have a little bit left over, and you have that fear of missing out, and you want to gamble a little bit and stay invested in some of those tech stocks, then you can, because you've planned well for your needs and your wants.
That's right. And people aren't crazy for thinking that, hey, I want some growth in the portfolio, right? Mm-hmm. You might want an inflation hedge. You might want to have extra money down the road in case you need full-time home health care or to leave a bigger legacy, okay? But for most people, those are things that are way down the road. You have to get to retirement first before you get 15 or 20 years in retirement and contend with these more futuristic, future-oriented issues.
Absolutely. Well, thank you so much for joining us on today's episode of the Retirement Income Source, where it's all about the income. And if you want to listen to this episode or maybe listen to past episodes, all you have to do is go to retirementincomesourceradio.com to watch all of our shows there.
And most important, make sure that you are here next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.